more of the day's market movements. Marcus Bogdan from Blackmore Capital joins us now live in the studio. Marcus, great to have you on board today. Look, it was a pretty ugly sell-off yesterday. What were your thoughts on that move?
Well, I think some sort of sell-off is inevitable given that we've had such a strong rise in markets over the last year. We've principally caught up to where we were pre-pandemic, and importantly, earnings have also caught up at that point. So we're about fair value and having a little bit of volatility and some opportunities to look at some new things is good.
So do you think the opportunity is now, or are you looking for a further pullback before you look at any stocks that look of value to you?
I think and this has been sort of consistent what we've been saying, is we're looking at those quality laggards and they've been underperforming for some time, and so we think that those valuations are still fair. So healthcare is a classic example where it's really underperformed recently, and so we think there's opportunities there, and then looking still in the value space as well.
Okay, so healthcare, where would you be looking? What are the opportunities for catch-up, given that we still are in this recovery phase?
Yeah, well, primarily CSL, which we've added to recently. It's been a really big underperformer over the last year, and we expect to see earnings recover quite strongly into 2023. Ramsay's also been another laggard, and then Helios also, given the fact that they've extended the pathology PCR testing for another year, is a great opportunity for that company.
Marcus, I'd love to get your thoughts on the commodities sector, particularly the gold miners, because gold is in focus. We're looking at inflation. Is that a sector that you like? It's very mixed out there as to whether people like it or not.
Yeah, so we've got Northern Star in the portfolio, and when we sort of hold that as a sort of a contrary position to other stocks that we've had. It's really struggled over the last year or so, but as these winds of inflation have started to pick up, we're now seeing some greater interest around that. So yeah, I think having some sort of gold exposure, particularly here, is a good offset in portfolios.
All right, what about retail, specifically the supermarkets? Woolworths and Coles both in the news, but Woolworths specifically because the Endeavour demerger. Yeah. I know it's one that you have in your portfolio. Is it going to stay there?
Yes, so we like Woolworths prima facie, and we also like the spin-off of Endeavour, and so we'll hold both of those stocks there. We think Endeavour, number one position in retail liquor with around 40% market share. The hotels business, number one position there in Australia, 9% position. We think that both of those positions, they can add value, increase margins, and then obviously the hotels have got the recovery coming through with reopening.
Is part of the Woolworths story this story of food inflation, that actually, protein is hard to get, which you hear about the chicken story, shortages in the US. Do you think that they're going to be able to pass on some of those costs to the customers?
I think what we're seeing now is we're definitely starting to see some pass-through. I mean, there's been very little promotional activity in the supermarkets. We are actually, in the last result, seeing some deflation in fresh in fruit and veg, but we're absolutely seeing strong inflationary pressures in protein, as you say. But more broadly, it's a strong cash generative business. After the demerger, they'll have net cash of around $75 million as well.
So why Woolworths over Coles then?
I think they're executing better, and then in the last result, online is growing nearly at 100% compared to Coles at 40%. And I do think, especially their smaller footprint is a more enviable position. And you've got the capacity to get a capital return with the Endeavour merger.
All right, let's talk financials now. Of course, the banks were out with their results a couple of weeks ago. CBA hit a record high, over $100.
Yeah.
What are you liking in that space? Is it any of the big four?
Yeah, we still like the big four. They've had a tremendous run, so we definitely prefer the mortgage banks, so CBA and Westpac as the strong recovery. But then also we're now looking beyond the big four and trying to find some value, and we think we've found that in something like Suncorp.
So why Suncorp?
So Suncorp had a better than expected result. They're starting to see some mortgage growth there. The NIM's stabilised. On fundamentals, they're relatively cheap, P of 13 times, a dividend yield of 5.5% fully franked, and quite an aggressive cost out program through digitalisation in the next couple of years.
And just looking at that chart there up on screen, their recovery from pre-pandemic highs, they haven't quite got there, so there is still some room to move. Is that your belief?
Yes, absolutely. And if you looked at CBA's chart, you would see it's well beyond its pre-pandemic levels. And so that's what we're trying to find. We're trying to find good quality franchises which have lagged the market.
Marcus, lots of ideas in there with some healthcare, some financials, Suncorp, CBA, Westpac, Woolworths and Endeavour Group. Thanks so much for joining us this morning.
Pleasure.
From Blackmore
Thank you.
Capital.
Cheers.